This is the fifth video of the series Security Analysis for Investment, and in this video we are trying to see how to calculate the weighted average cost of capital. Already we have covered the theory portion. In this video we will implement the calculations for this company, Tata Steel. But before doing that, let us first take a brief recap of the previous videos. We have conducted four videos or four lectures on this. The first one was the introduction to valuation, and where we discussed the philosophy of valuation, sources of bias in valuation, and how to control the bias. In the next video, we discussed about risk, and we defined the systematic and unsystematic risk and the beta. Then in the third video, we elaborated the cost of equity and explained to you the CAPM model. And finally, in the fourth video, we have discussed the theory of weighted average cost of capital, where we discussed cost of debt, levered versus unlevered beta, and then weighted average cost of capital calculations. In this particular video, that means in the fourth video, we have also introduced interest coverage ratio, which is required for which reason, to in order to determine the cost of debt. But in order to find the interest coverage ratio, we need to know the operating income. So earlier we have not introduced any concept regarding operating income. So in this video also I will tell you how to calculate the operating income by looking at the income statement. So first of all, if you look at any income statement, you will find the first top line is the revenue earned. If you take out the cost of goods sold, this is the minus sign. Please remember, this is not hyphen or dash or anything like that. This is minus sign. This is minus sign. Okay, so revenue minus cost of goods sold. What is cost of goods sold? It is the cost of the material consumed. That means whatever you sold in terms of number of units, the cost of those units will be the cost of goods sold. So if you take out that from the revenue, that will give you the gross profit. Okay, then if you subtract operating expenses from the gross profit, then you get the EBITDA, which is called the earning before interest, tax, depreciation and amortization. Now, if you take out depreciation and amortization from this, that means this portion you are taking out, subtracting from EBITDA, so you will get EBIT, and this EBIT is nothing but your operating income. So you can calculate the operating income in this way, directly from revenue, subtracting cost of goods sold, operating expense, depreciation and amortization. So that will give you the operating income. Now what is operating expense? It is generally termed as selling, general and administrative expense, but practically it is basically any kind of expense which is related to the operation of the business activities. So that is the operating expense. And operating income you have learnt already, and if you subtract the interest and tax, you will get the net income finally. So sometimes it is also possible that knowing the net income, we can backtrack the operating income. That means if you add the interest and the tax with the net income, that will give you the operating income. So this is called a bottom up approach of getting operating income, and this is the top down approach. That means if you are calculating from revenue, it is top down, and if you are calculating from net income, that is bottom up. So in this way operating income is calculated. Now let us come to a spreadsheet where we will implement all the calculations. That means the calculations for beta, for cost of equity, for cost of debt, and finally the weighted average cost of capital. So let us come to the spreadsheet. So here is your data. This is a 52 weeks data. the column B is for the weekly return percentage for Tata Steel, that is our company of interest, and then this is the column C, which is the return percentage of Nifty 50, that is our market. So now we will calculate the beta. How to find this data I have already told you using the investing.com website. In the second video where we were calculating the beta using the same process, we have already introduced the method. Just you have to go to investing.com and copy this data, that's it. And then let us calculate the beta. So first of all we will calculate the covariance of sample between these two arrays, array 1 and this is array 2. So what is the formula? B2 to B53 is your weekly return percentage of Tata Steel, and C2 to C53 is the same for Nifty 50. So that is the covariance between these two arrays. So this is the covariance, and then variance of market, again sample variance, var dot s, sample variance of market, this is your market, that means C2 to C53. So if you divide the covariance by the variance, you will get the beta. So the regression beta in this case is 1.30. So what was the formula? In the risk video, we have introduced the formula, that is covariance of the stock and market divided by the variance of market. So this is one method of getting the beta. Another method is calculating the slope directly. So slope coefficient, slope of y. What is y? Known y is Tata Steel. That means the stock of interest is your Tata Steel, which is the y value, and the x value is the Nifty 50. So if you calculate this slope between these two, that will give you the same result. That means 1.30, which is your regression beta. Why this is happening? Because already we have discussed the cost of equity formula. This is your cost of equity formula, RF beta into RM minus RF. You may remember that this was the risk-free rate and this was the risk premium, and this is the market return. So if you try to simplify this, this will be RF minus beta into RF plus beta into RM. So it looks like this will be constant, right? Beta is constant, RF is also constant. So this will be your intercept. This will be your intercept for the model, and this is the x variable, this is obviously the y variable, and this is the slope. So the market return is your x variable, expected return of the particular stock of interest is the y variable, and this beta is the slope. So that is why we are able to implement the slope formula here, and we are getting the same result, 1.30. So this is your regression beta. Now take a second and think about this. Is it a levered beta or is it an unlevered beta? What is this? So obviously this is a levered beta, this is not an unlevered beta. But the problem is here, in spite of the fact that it is a levered beta, the leverage here actually is the average leverage. That means the leverage generating from all the firms in the same industry or the same sector. But we are not interested in finding that beta. We are interested in finding the beta only applicable to Tata Steel. So this is a levered beta for the Tata Steel only, but the leverage is wrong. That means the leverage proportion is wrong. Wrong means it is average leverage, average of all the firms in the sector. we want the levered beta for Tata Steel, where the leverage is based on Tata Steel only. So hope you have understood. I am removing these all these junks from here, looking very not very poetic. So now consider these two formula. So unlevered beta is your regression beta divided by this, and then levered beta is unlevered beta into this. So first of all, we will calculate the unlevered beta, where using the regression beta, that means this one, and the average of D and E of the entire sector, we will find the unlevered beta. And then from that unlevered beta, we will find the levered beta of Tata Steel using the debt of Tata Steel and equity of Tata Steel. And in this case, how to find the tax rate? Okay, first of all, we will calculate. Let us take a approximate assumed value of tax rate 30%. We will later on change it with actual calculation. Now, what is the unlevered beta? This is the regression beta. That means this one divided by 1 plus 1 minus tax rate, that is 30% E11 into D average by E average, which we have not calculated so far. So we will calculate. So now if you go to this particular link that I have already posted here, I will give it in the description also. So of course you can do it for any other firm. I am doing it for Tata Steel. So in this money control website, they have given the competition. That means this is the Tata Steel and these are the competitors. So there are so many, so we don't want to consider so many. We will just consider the first five. That means Tata Steel and rest and the top four. So this is your data for the top four competitors and the Tata Steel. So from here we will find the required parameters. So first of all, we need to find the D by E ratios. So I have noted down these figures, just copying it from this balance sheet. So what is D by E? D is the total debt and E is the total equity. But remember, we have to use the market capitalization. What is market cap? Market cap is it is the total number of outstanding shares into market price of one share. Basically, it is the equity value in terms of market value. That means market value of the equity. If you take the uh, equity share capital from here, it will be the book value of the equity. That we don't want to consider. We want to consider the market value of equity, which is the market cap. So from where we will get the market cap? See, in the first table they have mentioned the market cap. So just note down these figures. So I have copied already. You can check this. JSW Steel is 184905 and here also 184905. So this is the market cap. In similar way, I have noted down the debt figures also. Where you will find the debt figures? This is in your balance sheet. You see, this is the total debt. These figures I have copied. So once this is done, you will calculate the average. That means the average of market cap, column wise average of these two columns, and then the ratio D by E. That means uh, this D by E for all. So you can see the average debt to equity ratio is 0.228. So we'll enter here. We'll enter 0.228 here. And for Tata Steel, it is 0.238. So we'll enter here also. Not much different. So anyway, this is the process you will follow. Whether it is different or not in this particular case is immaterial. This is the process. So it may happen that in some other stock, this can be significantly different from the average. Okay, so once this is done, your unlevered beta is calculated as 1.12, and from here you will calculate the levered beta for Tata Steel. So how to calculate that? Unlevered beta, that means this one into 1 plus 1 minus tax rate into this ratio. So this will give you the levered beta, that means 1.31. Now what is the tax rate? Tax rate is basically the marginal tax rate. Now we have assumed that the tax rate is 30%. Now let us find little bit more objectively how to find the tax rate. So for that we will go to the income statement. So this is the income statement that I have taken out from the investing.com for Tata Steel. So this is quarterly data, and if you can see here, this is the net income before tax, and this is the provision for income tax. So if you take these two ratios, that should give you the marginal tax rate. So but instead of taking the ratio for just for 1 year, it is a good idea to take the average and then take the ratio. That means if I copy this, to the Excel, this is getting really poor. So I'll copy this down and take this to the Excel. Okay, little bit okay now. So these two rows I am interested. So I will first take the average of the net income before tax and the tax paid average, and then I will take the ratio, this divided by this. So this is 0.2156559. That means that what is the tax rate? Tax rate is 21.59%. You can say 22%. So that gives you the levered beta equal to 1.31. So in the next page, we will calculate the cost of equity and cost of debt and finally WACC. So before doing that, enter the levered beta that we have found, which is 1.31. And then you have to find the 10-year government bond rate using the Bloomberg data. We have already shown this in the video. So for the India, it is 7.31%. So enter that 7.31%. What is the adjusted default spread? In this website, you will find this is the adjusted default spread, and also we need to note the equity risk premium. These two, remember, second column and fourth column for India. So this is India, second column and fourth column, 1.87%. 1.87% is the default spread, and equity risk premium is the fourth column, which is 6.42%. 6.42%. And what is the risk-free rate? We have given you the formula. Risk-free rate is equal to 10-year bond rate minus the default spread. So simply this one minus this should give you the risk-free rate. And what is the cost of equity? This particular expression is coming using CAPM. So risk-free rate plus beta levered into risk premium, that is 6.42%, this one. So this is your cost of equity. Now in order to find the cost of debt, you first of all you need to calculate the interest coverage ratio, and for that you need to know the operating income and interest expense. For that we will go to the income statement once again. So what is your operating income? This is 37125. Just enter here 37125. And what is the interest expense? Interest expense is 8894. So 8894, just enter here. So what is the interest coverage ratio? Operating income divided by interest expense. So the actual formula includes the lease expense as well, but for this company we don't have any lease expense listed down in the income statement, so we are just ignoring that. we are defining interest coverage ratio for this company as operating income divided by interest expense. So that is how the value is 4.174. And once again, from this particular link, the range is 4 to 4.5 and the spread is 1.59%. So the default spread is 1.59%. So what is the cost of debt? Cost of debt is your risk-free rate, that is this one, equal to risk-free rate, this one, B5, plus the spread, this particular spread, into 1 minus marginal tax rate. What is the marginal tax rate? This one, 22%. So this is just taking E11 from sheet 1 where we have found the tax rate. So in sheet 1. So this 5.51% is your cost of debt. What was the formula? Formula was risk-free rate plus your default spread into 1 minus tax rate. So that is what we have done here. So now what is the market value and market value of equity and market value of debt? So we don't have market value of debt. We will simply take the book value instead. So we have already calculated these things, right? So for Tata Steel, the debt value is 32275. Just enter here. Just make a link. This one. And the market value is your market capitalization, market cap. This one. So what is the D by D plus C? This is your D by D plus E. And if you subtract that from 1, that will give you the E by D plus E. So these are the two ratios. So what should be the WACC? That is this ratio into the cost of debt plus this ratio into the cost of equity. So this should be the weighted average cost of capital. So we will report that the weighted average cost of capital for Tata Steel is 12.24%. How you have calculated this? We have our cost of equity and we have our cost of debt. This into E by D plus E and this into D by D plus E. And we have added this plus this. This is our weighted average cost of capital for Tata Steel. So this is how the weighted average cost of capital can be calculated for any firm, and make sure that this leveraging operation is correct and these competitors has to be noted from the website. First 5 is perfectly fine. You don't have to take all the competitors in the same sector. And this is how we calculate the WACC. So hope you have understood. If you have not, then please play this video again and again unless you understand it completely, because once this is done we can further go to the next level, which is actually the valuation process. That means the valuation models, FCFF, FCFE and dividend discount models. So before that, this is necessary. So that's it for now. Let us meet in the next video. Until then, thank you and goodbye. Thanks for watching this video.